Hi, welcome to today's Arch Capital update. Now today I'm just going to go through a quick summary of the different types of super contributions and how much you have to take out as an income stream. Can be a little bit confusing, all the different words that are used, but I'll just draw it up quickly and hopefully this helps. So in your super fund, there are two main ways that you can make a contribution. One is what they call a concessional, but I like to call it a tax deductible contribution. And so that's the maximum you can put in is $25,000. Now that amount, that $25,000 into your super fund, normally comes from your employer, or if you're self-employed, you can put that contribution in yourself, or if you're not employed, you can put that contribution in. So that pays tax, this contribution. You pay 15% tax to put that into your fund, which is normally a better rate of tax than perhaps what you're earning at your marginal income tax rate. If you're a higher income earner, that contribution rate is 30%, but if you're paying 47%, it's still an advantage. So $25,000 is the maximum. If you've got multiple employers, you have to be careful because $25,000 is the limit. The other way to put money in is tax-free, or what they call non-concessional, but I like to call it tax-free. And you can put in $100,000 a year, and that doesn't pay tax at all. So that goes into the fund tax-free. Now that's money that has had tax paid on it somewhere in its life. It might have been from an inheritance or a sale of asset or just savings. And you've decided now that that's the best thing to do, to put that into super. You can put in 3 times that amount, so you can actually put in times 3, $300,000 into the fund in 1 year, but then you've got to wait 3 years to put another $100,000 in. And you can only do that if you're under 65, although they're just about to change a rule to increase that to 67. So 2 simple ways: your employer or tax deductible amount, $25,000, or your own money goes into the fund tax-free. Obviously within the fund, super funds, while you're growing, are taxed at 15% on their earnings while they're accumulating, and when you turn that into a pension account or when you're retired, that goes to 0%. So that's quite a nice outcome, up to $1.6 million, just to make it nice and simple. So only up to 1.6 mil, above 1.6 million is still taxed at 15%. And then when you're retired, you draw that money out as income. And there's a minimum amount, starts at 4% is what you have to take out. It goes all the way up to a minimum of 14% when you're 95 years old. And that amount that's drawn out, if you're fully retired, is tax-free as well. So hopefully that helps in terms of just explaining the types of contributions to make before 30 June. And also if you haven't taken money out, that your minimum amount. Now we've checked across all our clients, but if you're watching this and you're not a client, then you do need to take that out by 30 June as well. And make sure you do it all a few days before 30 June. You don't want to be doing it 11:30 PM on the 29th of June, just in case it doesn't go through. Hope that helps. Please call if you have any questions.